Hello, good afternoon. You're watching Closing Trades on 80 now. I'm Anisha Jain, with me Zavan Dubash, and for now the screen is looking all right, and that's because the Nifty has been holding around that 18,150 mark throughout the trading session. Yes, we haven't managed to scale the 18,200 mark, but clearly there's a lot of positive momentum build up which is happening at this point of time, and that's showing at the index level as well. In fact, the broader markets also continue to participate. The Nifty has hit a 3-month high on an intraday basis. If we hit that 18,200 mark, it'll be the first time since January 24th that we would see that mark. And the mid-cap index too has managed to hit a 4-month high. All eyes, of course, are on the Fed meeting. We'll get to know the outcome only tomorrow evening, but the expectation is a 25 basis point hike. Back home, it's metals and IT which is actually shining bright. So the metals is the top sectoral index, and IT too, led by the gains in Tech Mahindra as well as Wipro, is doing well in the trading session. And then, of course, there's earnings reaction galore, whether it's IDFC First Bank, India Mart, M&M Financial, they're all up in the trading session. And if you're looking at the smaller mid-cap names, the likes of Newgen Technologies, Datamatics, Aarti Drugs, these are the names that catch attention. They are up anywhere between 10 to 20%. So far, not much to complain, at least as far as the day and the earnings season so far is concerned.
Absolutely. It's a pretty stellar day of trade. The broader markets, as you said, neck to neck with the frontliners. There's some stellar price volume breakouts as well, and we'll be discussing all of those stocks. You discussed some of the newsmakers reacting to their numbers. Just want to revisit and run you and add to that list, actually. Atul Auto as well is in the spotlight. Their April sales numbers down 77% on a month-on-month basis at about 715 units, and that stock really bearing the brunt of it, with investors giving this one a thumbs down. Hero Moto as well, and it's come out with its auto sales numbers. They're down about 25% on month, and on a year-on-year basis, the auto sales numbers are down about 5%. And then there's RVNL, really no stopping this one. The company, latest in their news, has emerged as the L1 for the Chennai Metro Rail project, and we also spoke with the management then earlier today. They were very confident of continuing to maintain their revenue run rate. In fact, they said that the Navratna status is going to be a big positive in the formation of an SPV, which will help them foray into the foreign markets. 25,000 revenue growth by FY24 and a 30,000 revenue growth by FY25. The management said they are confident of achieving, and I think the proof is in the pudding. At least the street is giving this one a big thumbs up. Let's move right on and connect with our chartists as well. We've got Kunal Bothra as well as Naresh Mirani joining in at the top of the show. And Kunal, let's get in a sense from you first up. The fact that we've got support coming in from all quarters, the broader markets are looking resilient, 18,174. Your call was to book profits, right, on the index?
Absolutely, yes. And I maintain that stance on the index at least for the next couple of days, because the closer we are towards that 18,200 mark, the risk reward would be a lot more skewed to initiate a fresh buy. In fact, throughout the day, what we've seen actually is the index pausing. I think at 90 points, 100 points on the Nifty as well as 200 points on the Bank Nifty, maybe plus minus 20, 30 points for the individual indices. But then, the action is specific towards more stocks. And I think for the first time, we are seeing a lot of the mid-cap names showing a lot of high beta action for themselves as compared to the large cap stocks. So I believe that the action is bound to shift towards those mid-cap and the small cap end of the market right now. And the index as well as many of the large cap names could likely get into a bit of a pause. So that's why the shift of stance from moving out of the index towards individual stocks, and specifically the high beta name in the mid-cap and small caps.
Okay. Naresh, what's your sense? Because we were earlier also discussing the adage goes that sell in May and go away. But what about this May 2023? Is it going to be different?
That's something, if we look at it historically, you cannot actually make trading decisions on that. So the whole logic of selling in May, buying in October, etc. works well in a bear cycle. But as of now, we are in a bull market, so we could get into a pause. But overall, would not decide a trade or a investment decision purely on such seasonality. Every year is different. So for now, the markets are in firm trend. What we are seeing is it is not just the large caps, it is large caps, mid caps, small caps, micro caps. Everything has been trending up. So in such a scenario, you want to trail on to your positions. Yes, there would be pauses. We saw a pause at 17,800. We should ideally see a pause at this 18,200 mark. And say every time we take a step up, the previous step should act as a support. So 17,800 now becomes a support area. And 18,200, post that the next major resistance only comes at 18,600 to 18,800. So for now, the momentum is strong. The only case where the pause becomes much more necessary is the fact that on the Bank Nifty, which has been an outperforming index, at 43,500, we are just 500, 700 points away from an all-time high. That's like 1.5%, 2%. So out here, it's difficult to cross all-time highs in a single sweep. So the view is that these prices, we could see a pause on the Nifty, but stock-specific action should continue.
Slowly and steadily, we have come very close to that all-time high level, and just as you pointed out, 5 to 7% away from that mark. But let's talk about certain stocks and earnings reaction coming in for Datamatics. That stock is soaring 20% higher. The last time I checked, 19%. Mr. Rahul Kanodia, the Vice Chairman and CEO of Datamatics Global Services, is now joining us. Rahul, hi. Thank you so much for making time and speaking with us. Well, the year gone by has been quite stellar for you. 22% revenue growth, profit up around 20%. But the question is the growth in digital likely to be sustainable? Because the big peers are talking about slowdown in discretionary spend, and digital is also one space which is moderating as far as growth rate is concerned. Your take how FY24 will pan out?
24 looks quite promising. We don't see a slowdown in deal flow. Our market segments are responding equally well. Right now, we've incorporated, so to speak, digital across the board in all our offerings. So there is an element of AI, mobility, cloud across the board. So we are not seeing any significant slowdown on that front.
Seeing any significant slowdown? So 21% growth is what you clocked in FY23. What about FY24? And also a word on the margins?
So given that the market is experiencing headwinds, we expect that we would have a 14 to 15% growth next year. We're not seeing any major problems for ourselves, and the deal flow is quite strong. As far as margins are concerned, we had an EBITDA of 16.6%. I think we should be between 16 and 17, 17.5% next year as well. Because we've been able to tighten our costs, and the supply side demand is also easing off, and therefore I think we should be okay on the margin. In fact, it should improve.
Mr. Kanodia, hi there, afternoon. Given the fact that the majority of the revenue, at least from overseas, is a bulk coming in from the USA, can you just walk us through for BFSI with the slowdown taking place over there? Is that going to be a concern? Can we assume that the revenue from this geography will now be hit?
No, the revenue from this geography will not be hit. Our segment is the BFSI. That is the largest segment. It is a little softer, but I don't expect a major downturn in that front. In fact, the inflation in the US is helping us because we are able to go back and renegotiate prices with customers because they are experiencing higher costs themselves, both in the US as well as Europe. So I don't expect any major challenge on that front. It will be a little softer though, but it will not be negative.
You're also sitting on quite a bit of cash, at this point of time on your books. What are the plans for utilization of the same? And going forward, what are the new products you have in the pipeline?
So we are in negotiations with some companies and dialogue with some companies for acquisition. So we will acquire, our plans are to acquire somewhere between $20 to $50 million in acquisition this financial year. So those activities are going on. In terms of new product launches, actually, there are no new product launch. We are just augmenting the current base that we have. The market traction is very, very good for the products we have. Very good analyst support, very good customer feedback. Deal size is increasing. So with all of that, we just need to push that harder. So we don't plan to launch any new product, but just double down on the existing portfolio that we have.
Portfolio, not looking at making massive launches, but I just want to come back. I think you did point out that the revenue in FY24 is going to be 12 to 14%, or did you say 14 to 17? I missed out what you said.
To 15%.
Okay, 14 to 15%. But the other thing I was watching in your numbers was the fact that the client concentration continues to be quite high. Are you looking at diversifying? And with respect to the negotiations that you pointed out, are you able to get the realizations and price negotiation higher, or they've plateaued a bit?
No, we are able to get some price negotiations upwards. Our client concentration is not very high. The top 5 is about 24% of our revenues. And of course, as we acquire companies, that will probably come down. So I don't expect any major concentration challenge. The top 10 is about 36% of our portfolio. So.
Good to know. Thank you for clarifying that and giving us a sense as to how the business is shaping up, Mr. Kanodia. That's a word coming in from the management of Datamatics. Pretty confident that as of now there will be a little bit of softness, but no worries about a degrowth. 411 is where the stock is currently at. With news that we're at 18,170 and the broader markets up 1%, we'll take a very short break. Stay with us as our fundamental guest joins in to walk us through his outlook on the markets.
Well, in individual stocks which are buzzing in the trading session, you have Welspun India, which is up a good 16%. There are other textile retail names like Trend, Shopper Stop, other textile names like Indocount, etc. as well, which are reacting quite positively. And then, of course, the likes of KC International, Alkyl Mines, as well as RVNL are some of the big buzzers in the trading session today. But what are the closing trades that our chartists are strategizing at this point of time? Naresh, you go first. Naresh, I think you'll have to unmute yourself.
Looking at a buy on Biocon, the stock has finally crossed the last 2-3 months of high. The stock has reversed from the prices where it was in March 2020. So one of the worst performing ones. So carry a trade which could mean reverse going forward. So a risk reward trade here, expecting a big bounce in this one.
What about you? What's the closing trade you are spotting?
So I'll go with the stance of booking profits on large cap names which have done exceptionally well. So in the morning I had flagged off L&T. Currently, I think Bajaj Auto is also something which has come back towards my expected target range around this 4,400 to 4,500 range for Bajaj Auto. So that's a stock where I think would recommend to book profits as well as doing the same for my clients.
All right, there you have it. That's the closing trade from Kunal and Naresh. Let's move right on, and Rupesh Patel is joining in. He's Senior Fund Manager, Equity Investments at Nippon India Mutual Fund, to give us a view on his outlook on the markets. Thank you so much for taking time out and joining in. Rupesh, to begin with, just give us the outlook on the markets at the current juncture, given the fact that we do have the macros as well supporting us, the fact that the broader markets as well are neck to neck with the frontliners, if not outperforming. The earnings season so far hasn't been too bad. Do you think all of these ingredients make for a further up move in the markets, or we run out of steam?
So thank you so much for having me on the show. If we try to understand current context of the market, then very clearly from macro perspective, we are seeing effects of higher inflation and interest rates on growth. It's very visible in global economy. It's very visible in case of domestic economy as well. So if we look at the domestic economy, then consumer-facing sectors, I think across the board, if you look at numbers or commentary coming from various managements, it's becoming clear that there is some kind of slowdown which is there. However, if we are willing to look ahead and maybe a few quarters out, we are looking at a scenario when this would be there in the base. This slowdown would have already played out, and markets have not gone anywhere since last 18-19 months or so. So valuations are in line with our longer term averages. They are no longer expensive, which was our concern till few quarters back. So I think near term uncertainties remain, but the longer term India story remains intact. And I think markets currently are giving a good opportunity to construct a portfolio from medium to longer term perspective.
Good opportunity to construct a portfolio, Rupesh, but what are the ingredients of that portfolio that you think should get the higher weightage? Because I'm especially intrigued by the big moves that we are seeing in the railway counters, RVNL, IRCON, IRFC, etc. I know it's a small space, but for railways and industrials as a whole, what's the stance?
So our view on domestic capex continues to remain positive. I think a lot of it is driven by government focus. So focus on railways, focus on road, focus on spending behind defense. I think that continues to remain there, and it's going to be a big driver. On top of that, opportunities arising on account of China Plus One playing out, that also adds to the capex momentum. So that's on the capex side, coming from the government spending on sectors like railways and roads. But on the other side, sectors like renewable, that is where we expect that spending will pick up going ahead, considering the targets which we have to achieve by 2030 of 500 gigawatt renewable energy capacity. So even if a meaningful percentage of that has to come up, capex has to happen across the chain, whether it is on putting up this renewable capacity on the ground or behind upgrading the transmission infrastructure.
Okay, Rupesh, wanted to understand, do you have any outlook that's favorable when it comes to new age tech companies, or do you think that it's a sector that one needs to be very stock specific or circumspect on?
So I think it's a great question, no doubt. I mean, when we look at some of these new age tech companies, the opportunity which is in front of them, that's huge. And we will see that some of these companies, they will be very successfully able to capture this opportunity. And they would be able to capture this opportunity, more importantly, profitably. So the ones who will manage to capture this opportunity profitably, they would be the big winners in terms of stock price performance as well. So I think our approach over here is more bottom-up basis. You have to look at individual sectors, companies in that competitive landscape, what kind of capital is coming. Have to take a call accordingly. But it's more like an optionality play today than taking a view on numbers, say a few years out, and evaluating them on the basis of multiples, which we typically tend to assign for a steady large cap company.
What's the favorite at this point of time? This top sector, which seems to be like a consensus buy, is it financials for you as well?
Yeah, I think today, if you look at our portfolios across the board, in fact, we are overweight on financials. And within that, we have overweight stance on large cap banks because that's where we believe that they are very well capitalized. Asset quality problems, they are behind us. All the NPAs of previous cycle have been recognized, provided for. In fact, we have started seeing managements providing future increase in NPAs. Managements have started providing outlays for that. And most of these entities, they have very strong CASA franchisee, which helps in current interest rate environment as well. And valuations are reasonable in the overall context of the market. So yes, that's a segment where we have overweight stance, and we continue to have that.
Okay, fair enough. Take us through whether or not you're worried about inflationary pressures eating into demand when it comes to the entire consumption space. Would you be selective within this pocket?
Yeah, very clearly. Today, when we look at companies, do ground checks or talk to managements, it's very clearly coming out that there is some kind of slowdown because of the price increases which companies have taken to counter some of the inflationary pressures. There is impact on volume, and we believe that the near-term impact will continue to be there. But if we are willing to step back and look at the big picture, the longer term story behind consumer, particularly in discretionary space, where if we look at it from India's per capita point of view, or we look at the opportunity in terms of increasing penetration, or we look at opportunity in terms of increase in premiumization trends, I think the longer term opportunity is pretty much intact. But in near term, we may see a few quarters wherein volumes will remain under pressure.
That's the take coming in as far as how the macro setup is looking like and how one should approach individual sectors. Just before I let you go, Rupesh, a quick word as far as what's your stance on the real estate sector? Are you playing it through the building material or cement space, or not so positive on real estate?
So we have a basket approach over here. We have exposure to some real estate developers, and we also are playing it through exposure to cement names as well as some other building material names. So our approach is more bottom up over here, and it's more of a basket approach wherein, in terms of developers, we are betting on some specific micro markets where we have taken exposure through individual developers. or on a very broad basis, cement, not only real estate, but it gives us play on overall spending on infrastructure also picking up. So cement, building materials, individual developers, it's the combination of all of these.
Thanks so much for joining in and sharing with us your outlook on the markets and what the view has been on individual sectors. All right, let's get a move on then and reconnect with our chartists to get their outlook then on individual stocks. And Kunal, what's the view on Indian hotels? You've got a lot of brokerages that have been, maintaining a thumbs up. We spoke with the management who sounded very confident. After all of the result reaction, what's the best case scenario?
Yeah, I think the best case scenario is still playing out for Indian hotels. I think
in terms of target price,
365, 370 could be a near-term target. So, it's a low beta name. The stock, I remember so clearly that I think almost 2-3 years back, the stock used to stagnate at the 160, 170 mark. It spent almost 1 to 2 years at those levels of 160 plus. And the moment the stock managed to break out, the movement initially was very slow, gradual for Indian hotels, and then it picked up pace in the second half of 2022. Even the current charts are very similar for the stock price. We've seen a breakout for Indian hotels, a good recovery from the 300 levels. But then I think because of the low beta nature of the stock price, the movement on the upside would be very slow, gradual for Indian hotels. So 365, 370 could be a near-term target for Indian hotels, but I sense that may take at least 1 to 2 months for the stock to try and hit those kind of target ranges.
Okay, in the meantime, we spoke with a whole host of managements today to try and dissect what's happening with their earnings and what's the outlook, right from RVNL, Mahindra Finance, L&T Financial Holdings, and even a lot of other names like RBL Bank, etc. as well. Let's play out some of those bites for you, and even IDFC First Bank for that instance, because that stock is up almost 3%. Let's play out the bites of RVNL, IDFC First Bank, and a couple of other financial managements whom we spoke with earlier.
The Navratna status for us, it's a very big thing for us, and it will, in the present ecosystem in which we are working, it will give us a huge impetus in various fields. So the first and foremost is it doubles our delegation to invest this thing. It empowers board to invest in a single proposal to 1,000 crores as compared to 500 crores earlier. So it helps us in formation of SPVs when we are going for HEM models. We are going for SPV for creation of SPVs for forays into foreign markets. To that extent, it's a huge plus for us. It will give a lot of confidence to the banks and this thing when they deal with us. So I'm very sure it opens a huge vista of opportunities for RVNL. Whatever money is the borrowed, I don't think it will have any impact on that, because that is what we have already entered into the agreement. But we are going into a lot of HAM models in national highways or formation of SPVs like for train sets, what we have got a big order. So when we negotiate with the banks, definitely the financing cost will definitely be, I think it will be much more favorable compared to what we have been getting till now.
I think clearly we have seen growth across the country without exception in every state and almost every product, which is why, cumulatively we said that the sentiments are very, very positive. We have not seen any pressure in any segment, at least at this stage, and we continue to believe that they would not do well. I think I would like to remind that we are playing in the largely earn and pay segment. And that's a reason a couple of years back we had pressure when this segment was not doing well. Currently, we see almost all vehicles, tractors, everything is fully deployed, in fact, to their full capacity. And we don't see any pressure on that front. And we continue to believe we would do well. In as far as the personal segments are concerned, we have entered the affluent customer segment, and we are offering very competitive rates out there to be able to compete, and that's helped us even gain market share. So you should overall understand that the segment that we were largely present in is doing pretty well. The new segment that we have entered into, we are actually gaining market share. And then thirdly, we have added new product lines like SME, LAP, etc. The three things together is what really driving the growth, and we don't see any concern around that.
We believe that about a 23-25% growth rate we should sustain for a long time. Last year also was 24%. And considering that, most banks, I'd say, are posting about a 20% growth rate in retail. 24 for us, coming from a lower base, should be reasonably possible. See, last 4 years also at a stretch, our CAGR growth and deposits is something like At least retail is upward of 70%, which I'm now talking of 40%. I'm talking of slowing down, but still it's good, like 40%. Yeah, even 25, 26, we feel the bank will be very strong in deposit. I'd say moderate growth, actually. No, I'm not, by the way, very different than others. If you see the whole banking system is talking of a reasonable growth, you see like between 17, 20%, everybody's posting. We're talking of maybe 23, 24. But I'd say that on the deposit side, of course, we expect to be continue to be very strong. That is one. Two is that I'd say that all the work over the last 4 or 5 years from my predecessor's time in building the bank and time, all that will come to fruition. We must have lost 2 or 3 years because of some issues here or there on a few things, COVID and bad loans and all that. So, but I think that phase is behind. If you look next 5 years, you should be, let me say, pleasantly surprised. You'll forget the past. Now we are collecting 99.5 to 99.6% consistently. If you collect 99.5, only 0.5% moves to 0 to 30 DPD. If we sustain this, we are determined to sustain this. Our net NPA numbers on retail is 0.55%. Our gross NPA in retail is 1.55%. So we are very clear that we will not want to leave asset quality as an issue. And of course, we have to be very watchful for that, but we will be.
Our intention is to grow the credit to the tune of around 15% and retail to the tune of around 20% on an annualized basis. So we have just exited the year, rather the annual growth for retail was 21% and annualized growth itself is 24%. Sequentially, we did around 8%. And overall credit growth has been 17%. What is interesting to see is that housing loan, LAP, both put together was able to give me an 806 crores of last month growth. That is one. The second, housing loan per se itself has grown by 900 crores in last quarter. So these things will continue. In addition to that, we will have a two-wheeler, used car four-wheeler, then we will be having gold loan, we will be having education loan, we will be having SME loan. We are coming with the BBG, that's a business loan. All these things are in the form of being underway now, and it may start delivering from Q2 onwards. With all these things, we are gaining around 20% growth is the minimum what we are looking at.
Thanks for staying on with us. Let's connect with Siddharth Khemka as well, who is joining in, Head of Retail Research at Motilal Oswal. Siddharth, thanks so much for taking time out. Let's begin by getting your take then on the IT majors. With the earnings done and dusted, what's your outlook in terms of pecking order for tech majors?
Yeah, very good afternoon, Navan. So if you look at the overall IT space, the results was not expected to be pretty strong on back of the global turmoil that has been witnessing. However, if you look at some of the larger ones, disappointed even on the outlook with Infosys downgrading the guidance and the near-term visibility very weak. Somehow the mid-cap and the tier 2 IT companies, some of the niche players have been able to report very strong numbers, and as well as and the outlook for growth is pretty strong. So overall, we are right now kind of neutral in the overall IT space. We believe that the near-term challenges would persist and impact the near-term growth, especially for the tier 1 players, be it the Infosys, TCS. However, the long-term outlook continues to be pretty strong, given that they are sitting on record order books. Things would return back to normalcy once there is clarity in the key regions of US, Europe, in terms of the slowdown and economic growth coming back. So I think bearing the near-term weakness, marginally people could look at gradually accumulating some of the quality stocks. In terms of pecking order, within the large caps, we like TCS, HCL Tech, followed by Infosys, where the earnings downgrade has been pretty sharp. Within the mid-cap space, we like Persistent and Cyient.
just getting numbers from UCO Bank, so let's address that. There's a definite improvement when it comes to the gross NPAs. It's down to 4.78% versus 5.63%, and the NII too is up around 20% on a year-on-year basis, and we're seeing a bit of a reaction on the stock as well. So 2% provisions are a bit elevated, and that's why perhaps the profitability is around 580 crore. But nonetheless, I think it will go down as a decent set of numbers. Asset quality is better, as well as you have the NII growth of around 20%. But we are talking about the aviation sector and how Go First has actually stopped bookings for the next 3 days. Why is that, and what's really happening with that particular company? Let's go across to my colleague Sameer to find out more. Sameer, what's the latest?
So there, what we are getting to know from our sources that more than 50 of the aircraft of Go First aircraft that is grounded because of the engine issues, and now not just this reason, but there are financial reasons as well. So clubbing these two reasons, but we are seeing that for the next 3 days, on 3rd, 4th, and 5th May, Jet Airways, Go First has stopped taking bookings, the ticket bookings for these particular 3 days. Though we have not received any official communication from the airline, they have not commented as of now. But yes, what we are getting to know from airline riders and other sources that majorly because of the aircraft being grounded, the airline is not in a condition to provide services for next 3 days. And the ticket bookings have been stopped for these particular 3 days. In addition to this, now what we are also seeing that many of the Go First flyers, they are now posting their problems, their issues with the airline on social media. We have seen that there are multiple issues that have been posted related to the cancellation or refund of the ticket. And now what we also understand that maybe late in the evening, the aviation regulator, DGCA, or even the ministry, aviation ministry may step in and will try to look into the issue. But definitely it seems that the Go First problem will continue to deepen in further time.
Just to clarify, will the aircraft or the people who have booked tickets for next 3 days to fly on Go Air, airlines, will that completely get stopped? The flying of the airlines, or only the bookings of future, tickets is going to get stopped?
For these 3 days, the bookings have been stopped. But those who have booked in advance, as of now, when we are speaking, it is communicated that they will be able to fly. Their flights will be there. But what we see as a larger picture, that it might be not as easy for them because the aircrafts are grounded. More than 50 aircraft are grounded because of engine issue. So it is very likely that Go First will not be operating with full 100% capacity with whatever serviceable flights they have. So it is very likely that, okay, on one side they have stopped taking the ticket bookings, but yes, they will not be able to carry out the full flight operations. So there might be, we may see that the flyers may be raising their queries or issues for next 3 days. That is on 3rd, 4th and 5th May.
Thank you so much for joining us and giving us that update. So Go First and the flyers, please be careful with respect to the latest updates coming in and keep track whether your particular airline is flying or not for the bookings over the next 3 days. But Siddharth, just coming back to the point of the earnings, the small and the mid-cap banks have also reported a decent set of numbers. Anything that caught your attention? IDFC First Bank, RBL Bank, and even now UCO Bank reporting its numbers.
Yeah, Anisha, so if you look at bulk of the banking earnings are now in, except for SBI, the big daddy. Earnings growth remains strong. We saw earnings from Axis, Kotak, smaller ones like IDFC First, RBL Bank. The earnings were better than our expectations, while some of the other ones like HDFC, ICICI, IndusInd were in line with our expectation. But I think across the board, we have seen NIMs improving, deposit growths remained healthy, provisions were lower than expectation, which led to better than expected profitability. But what looks like is from here on that NIMs will start to normalize. There is hardly any levers left for further improvement in NIMs. So kind of the growth we are seeing in the quarter cannot be extrapolated for the full year FY24. But having said that, I think the overall earnings season looks pretty good, has been single-handedly held or you can say led by the banking space, in which I think some of the smaller ones have really done well. IDFC First is something that we have been liking for some time. The earnings momentum is now picking up. The granularity in the books is something that we are liking. I think that is really heartening to see that the overall earnings asset quality is expected to improve. We believe that IDFC First is entering a phase of strong loan book growth, and the drag from the legacy wholesale book is now expected to moderate. So that should lead to an almost 31% earnings CAGR. ROAs should improve to 1.3%. So that makes us pretty positive on IDFC First. We have increased our target price to 75 on IDFC. Earlier, we had a target price of 70.
With us, lots more to talk about. Shrishti, my colleague, is joining in right now to give us a sense as to all the auto sales data that has been trickling in. Shrishti?
Okay, well, this time around, if we talk about the auto sales data, so a disappointment coming in from the major segments. But if we have to pick up the outperformance this time around, then it clearly is Tata Motors passenger vehicle, Eicher Motors Royal Enfield segment, as well as M&M Bajaj Auto. These were the four companies, or the segments rather, which has done better in terms of the estimates of ET now. When it comes to the commercial vehicle segment specifically, then a sheer disappointment coming in on that front, because all these companies have performed worse than what we were expecting at ET now, and a decline of 50% sequentially is what we have seen, because we indicated earlier as well, because of the RDE norm implementation, there was a lot of pre-buying that happened in the month of March. So a sequential decline was expected, but nevertheless the companies have reported the numbers on the weaker side itself. Coming to the two-wheeler segment here, and we get to see a mixed bag, because from the likes of Bajaj Auto and Eicher Motors Royal Enfield, these have been the clear winners in terms of the expectation and the actual report, the numbers that were reported. For Bajaj Auto, there has been an uptick of 14% on a sequential basis. As far as for Eicher Motors Royal Enfield, 73,136 is the number that the company recorded. When it comes to TVS Motors, almost in line set of numbers is what the company reported, with a growth decline of 3%. And when it comes to the Hero MotoCorp numbers, then a 24% sequential decline is what we have seen, and that's the reason why you are seeing a cut on that particular stock. Coming to the tractor sales, this time around, not much was expected, and the companies have performed a tad bit weaker. The expectation, Escort sales were down 27% on a month-on-month basis, while for M&M there has been a marginal increase with a 4% uptick. And lastly, when it comes to the passenger vehicle segment, not much of a great set of numbers were expected this time, but nevertheless, Tata Motors passenger vehicle as well as M&M has performed fairly better than what we were expecting, while for Maruti Suzuki, the numbers were in line to what we were expecting. So I have to say that the majority of the numbers were on the weaker side itself.
Numbers on the weaker side. Siddharth, your take as far as the auto counters are concerned. What are the favorites?
Tanisha, I think clearly the numbers are can say segment-wise, we are seeing the divergence between the segments. Clearly, the passenger vehicle segment, we are not seeing that kind of growth. But if you look at the CV side and the two-wheelers, there again, the two-wheelers are still getting impacted because of the low consumer demand, the rural growth that we are seeing overall across consumer names. Monsoon again this year is not expected. There's not much clarity, but I think the expectation is not pretty strong with both SkyMet and IMD at 90 to 93%. Although it's said to be a normal monsoon, but could be below that because of the El Nino impact. So don't expect a strong recovery. I think overall the CV side is something that is being pretty heartening in terms of the recovery that we are seeing. And on the passenger vehicle side, the EV side that is seeing a strong growth. So I think our pecking order within the overall OEM space is we prefer the CVs where Tata Motors comes in, Ashok Leyland comes in. Tata Motors also is doing good in terms of the domestic EV space with its passenger vehicles, almost 80% market share. I think those are our preferred picks within the overall OEM space.
All right, stay on with us, and that's the view coming in on the entire auto space as a whole. But moving right on, the Finance Ministry has held review meetings with PSU banks. Let's take it across to my colleague Sumit, who joins in with what exactly has been discussed in those meetings. Sumit?
Well, the overall process of recovery of the loans which have been written off, well, government is going tough with PSBs on this issue, and that's regarding what meeting has taken place today. The issue of overall recovery of written off loan is like this. The amount is staggering. In the last 5 years, over 7 trillion rupees of loans have been written off. The recovery has been just 1 trillion rupees. So, Finance Ministry has put a target of recovery of 2 trillion rupees in current financial year alone. They want banks to use any method or using bad banks, using any recovery tribunal, anything, but these loans recovery should be higher. Currently, the ratio or percentage is 15%, but Finance Ministry wants this to go up to 40%. So they also put emphasis on that all the pending cases in Supreme Court, High Courts, Appellate Tribunal, they all should be looked into, and PSBs should get into the mode of recovering loans faster. Earlier, the recovery of loan was slow. Government is clearly not satisfied with this, and that's why the higher target has been put in. And regarding this, the meeting has taken place, and PSB have been told to expedite the process of recovery of the loans which have been written off. In this year alone, in the last 9 months, around 1 lakh crore rupees of loans they have been written off, and government is clearly not happy with this. So loan recovery has to be expedited, and that's for that meeting has taken place.
Thank you so much for bringing us those latest details coming in. But time now to talk about some earnings which are expected as well. Tata Steel is the stock which is in focus, wherein there's a lot of expectation from the domestic business, though the European business is expected to remain a tad bit sluggish. Nuresh, your take as far as the stock of Tata Steel is concerned? Any trade that you're spotting?
So, seeing a little bit of a momentum move today in a lot of steel names. Tata Steel is the one which could be interesting purely for the fact that the stock has done nothing for a long period of time now. After that correction from the top, the stock has been very sideways. It's trying to make a breakout move above 111, 112 levels. So out here, it's a risk reward trade wherein you keep a stop loss at 108. I expect a move towards 120, 22 levels. The most interesting name continues to be Jindal Steel in the large steel names, which is the stock at 585 to 595. Is just 20 bucks away from an all-time high. So clearly a leader out here. So if one is looking at an exposure in steel, one could go with Jindal Steel and Tata Steel.
Pull up the intraday chart of Indigo for the time being, and even SpiceJet. The negative news flow around Go First is something which is being lied, at least by the investors of Indigo and SpiceJet. It seems people are now talking about how Go First is going through a lot of issues, and perhaps that's the reason the other airlines could stand to benefit as well. Kunal, your take as far as Indigo is concerned, and as well as a word on Titan. We're expecting the numbers to come by tomorrow. Any trade you're spotting?
So Titan looks attractive. In fact, I think the stock in the last 1 week has done reasonably well from 2,550 to now 2,660 levels. Again, a slow mover for itself. I would expect that possibly post results, assuming there is no kind of negative news flow or event post results, the stock could probably come back towards 2,750 mark as well. So I would expect at least another 80 to 100 points upside for Titan from current levels. Indigo on the other hand is very attractive as a chart, because I think for the first time the stock is showing signs of both momentum as well as breakout. Combined, the volumes have been quite strong for Interglobe Aviation today. That makes the trade as well as the setup very attractive. So I think keeping maybe yesterday's low as a stop loss, which is around 2020 odd mark, I think Interglobe Aviation could be a good buy. Targets on the upside would keep it closer to 2120, 2150 levels.
All right, let's move on then. Titan all set to come out with its numbers. What is the street expecting in terms of revenue as well as net profit? Let's take it across then to Vinny, who joins in with all the details, as we'll be keeping a close eye out on the quarterly performance for Titan. This is, of course, come tomorrow. Vinny?
So the jewelry maker Titan is expected to report its Q4 FY23 numbers. We're expecting a double-digit growth of 24% in terms of the total revenues of the company. Obviously, we do have a fair idea of what to expect because of the operational update. Profits of the company expected to see a growth of 54%, while margins expected to see an expansion of around more than 100 basis points at 12.1% versus 10.7% are the EBITDA margins last year. Now, revenue growth will be mainly aided by the higher growth and contribution that we're seeing coming in from the watches segment, as well as the other emerging businesses which have seen a strong growth as well. We are expecting to see an improvement in the studded ratio. It's expected to come in somewhere around 35%, which obviously will augur well for the margins of the company. When the studded ratio is higher, that works out well because they are high value products. So that is why margins also expected overall to start seeing an improvement and will come down in terms of the margins and the profitability as well. Obviously, profitability is expected to be better in most of the segments as well across businesses. What the commentaries come in terms of operational update is that Jan and Feb saw a strong demand and contribution in terms of performance from consumers, but March, that was a bit of a subduedness that they saw because of the hike in gold prices. So in terms of commentary also, we'll watch out for what is the impact of the gold prices, anything in terms of consumer sentiment getting impacted. Competitive landscape is a factor we are keeping an eye out on, and in terms of any change in product mix, performances of watches and wearables as well as the eye care business is something that we're keeping an eye out on.
Thanks, Winnie, for that. But let's get the BTSC ideas also from our technical experts. Kunal, you go first.
So I'll go with two buy calls, different names, again concentrating on mid-cap end of the market. Two buy calls, Hindustan Copper as the first stock, suggesting a buy the stock, giving a breakout above 104 levels. So would suggest a buy with 112 as a target for Hindustan Copper, stop loss at 100. And Astra Micro is an interesting name, classical setup in terms of volumes. The last 4 days, the chunk of volumes for the stock is significantly high as compared to the historical last maybe 15-20 days of comparison, which indicates that there's been strong buying which has happened to the stock. So would suggest a buy 330 as an immediate target, stop loss at 305.
Okay, since you have mentioned Astra Micro, let me bring on board Siddharth as well and ask his take regarding some of the other defense names, because as we speak, Garden Reach as well as Cochin Shipyard, they are up around 7 to 8%. What are the top picks within the defense names, Siddharth?
So, Anisha, unfortunately, we don't have coverage on a lot of these defense names, the focused defense names. But I think what has happened is that over the last few years, the way the sector has opened up, there has been a lot of orders from the government side. But also what has happened is that exports market has helped some of these domestic defense companies to garner good demand, and that has led to a strong order book. Also, the execution has taken place a lot well compared to a lot of earlier when we had seen that although there was a lot of promise from the defense sector, but they always lagged in terms of execution. But finally, that is taking shape with the overall improvement in the operational performance for a lot of these stocks. So overall, I would say that this is a good space to look in, but unfortunately, right now, we don't have any active coverage on the space.
All right, that's the view coming in. But Kunal, let's get in your BTST trades. Naresh, sorry.
So first would be a buy on Biocon. Finally, the stock has started showing a reversal and crossed the last couple of months highs. Momentum here could continue. Stop loss at 235 and a target price of 250. Second is a buy on Maruti, which is getting closer to a short-term breakout. A stop loss at 87.50 and a target price of 89.50.
All right, that's the view coming in. Meantime, let's find out what exactly, Siddharth, your outlook is when it comes to betting on some of the names within the media space. Of course, each one has a very different, fundamental story behind it. But given that Zee Entertainment is now close to sealing the deal with Sony, we have seen some amount of better content for films like Pathaan for multiplexes. What's your outlook?
I think the entire, if you look at media space, there are hardly a few companies which are there on the investment radar. We have coverage on Zee with a buy rating. Obviously, there was a big overhang with these several cases that has been going on, and which put a question mark on how the merger with with Sony would go forward. But now I think most of the cases are resolved. The merger will go through, which is bringing in a lot of synergies, which will also reduce the corporate governance overhang that was there on Zee by itself. In terms of content, I think both Zee and Sony combined will be one of the market leaders in the entertainment space, and that should do well. But having said that, I think the near term, the stock price will be dependent on the news flows that keep coming in, and hence the volatility may not go away. mostly, I think, from a long-term perspective, one should look at the media space, especially if you look at Z. Near term, I think, as I said, the volatility could continue. But the long-term view now, with the clarity coming in with the merger, I think that should be positive.
What about the urban consumption theme, the likes of Trent, Shoppers Stop, and the other retail names as well, and even QSR for that matter, Sapphire, Devyani, etc.?
So yeah, I think that is a space that we saw doing well at least until the festive season, but saw sharp decline both in terms of, you can say, footfalls, in terms of demand after the festive season, and which was a big concern given that urban consumption or urban demand so far had been resilient while the rural demand was under pressure. But I think now gradually things are stabilizing. The high base effect is also going away. The cost pressures are easing off for sure. If you look at a lot of these commodities, the palm oil prices have come down. A lot of other wheat and other raw materials that had gone up is now kind of cooling off, and some of these companies have taken up the price hikes, which is helping them improve the overall profitability. I think, and from now on, we can expect a gradual improvement in overall demand. That is what we saw in terms of the QSR companies, in terms of the retail companies, and also especially if you look at the leisure segment, the hotels. We saw the results from Indian Hotels yesterday. Lemon Tree, pretty strong results where the discretionary spending has been a key factor and has been pretty strong. So I think that on back of that, some of these retail companies would recover. Trend is something that we have been liking from a long time from the overall retail space. I think that should do well.
All right. Thanks very much, Siddharth, for sharing with us your outlook. Let's wrap up the markets then, and we kickstarted a